Target is entering the holiday season with brutal reality, a 19% profit drop and 3 straight quarters of declining sales. That single fact tells you everything about where the company stands right now. Under pressure, losing momentum, and struggling to maintain relevance in one of the toughest retail environments in years. This isn't a one-quarter stumble. It's a pattern. Profit down 19%, comparable sales down again, customer traffic shrinking, and even the shoppers who still show up are spending less than they did a year ago. When every core metric moves in the wrong direction at the same time, you're not looking at a bad moment. You're looking at a business model that's being stress tested and cracking. What's driving this? It's not one issue. It's a collision of consumer behavior, operational weakness, and a brand erosion, all feeding on each other. Consumers are under pressure. Inflation has reshaped their priorities. People are spending less on non-essentials, the categories Target depends on. Home decor, apparel, seasonal items, they're not moving. Instead, customers are shifting to groceries, beauty, and everyday basics. That shift is lethal for a retailer built on the promise of nice things at a good price. When shoppers stop buying the nice things, the Target machine breaks rhythm. But here's the part no one wants to say out loud. The stores don't feel like Target anymore. For years, the brand had a clean, stylish, enjoyable atmosphere that made shoppers feel like they were getting something better than Walmart without paying upscale prices. That experience is fading. More customer complaints, messier aisles, difficulty finding staff, slower service. When perception shifts, foot traffic follows, and that's exactly what we're seeing. Then add the external hits. Tariffs, supply chain friction, a long government shutdown that disrupted spending habits months later, and yes, the DEI backlash and customer boycotts that hit early in the year. Whether the backlash was fair or exaggerated doesn't matter. It dragged on the brand during a sensitive period. When consumers feel financially squeezed, any controversy carries extra weight. Meanwhile, Walmart, Target's closest and most dangerous competitor, is thriving. Same environment, same macro conditions, but Walmart is gaining traffic and increasing market share. That contrast exposes something important. Target's weakness isn't the economy, it's internal. So what is Target doing about it? Not small tweaks, not surface level fixes. The company is attempting a full-scale reorganization, a reset of how it operates, how it sells, how it fulfills, and how it uses technology. Next year, Target is launching a massive $5 billion investment plan, including an additional billion added recently because leadership realized the problems run deeper than expected. Nearly 2,000 stores will receive remodels or operational improvements. Technology infrastructure is being rebuilt, digital fulfillment is being modernized, new locations are planned. This isn't housekeeping, it's reconstruction. And the restructuring has already started. Target eliminated around 2,000 corporate roles, about 8% of its headquarters staff, to speed up decision-making and reduce layers of complexity. Big companies don't cut that deep unless they know slowness is killing them. But here's the surprising part. Despite the rough headlines, Target's digital capabilities are actually outperforming the rest of the business. Over 95% of all digital orders are fulfilled directly from stores, a model that cuts fulfillment costs by up to 40% compared to centralized warehouses. Same-day services, drive up, order pickup, and shipped grew more than 35%. Target processed over 200 million same-day orders last holiday season, and its next-day delivery reach now covers more than half the U.S. population. In a retail world shifting towards speed, this matters. Target is also going aggressive on AI. Its design teams use a system called Trend Brain to predict upcoming colors and styles. Marketing teams test campaigns using synthetic AI-generated shopper models to forecast reactions before real customers ever see anything. And now, with the OpenAI partnership, people will literally be able to browse and buy Target products, including groceries, directly inside ChatGPT. That's not a gimmick. That's a new traffic source. But let's be honest, none of this fixes the present. These improvements take time, and Target itself is signaling caution. Leadership expects holiday sales to decline again, this time in low single digits. They even lowered the top end of their full year EPS guidance from $9 per share to 8. Companies don't soften expectations heading into the most important quarter of the year unless they know the environment is fragile. And the stock, it reflects the damage. Down roughly 40% over the last year, trading near $88. Analysts are mostly calling it a hold. The average 12 to 18-month price target sits around 103. But historically, analyst price targets are only accurate around 30% of the time. Take that number as a suggestion, not a prediction. So the real question is this, and it's the only question investors should care about. Can Target convert a $5 billion reinvention into real traffic, real revenue, and real momentum before the market loses patience? If the answer is yes, today's valuation isn't just attractive, it's a potential setup for a long-term rally. The stock trades at a discount to Walmart and Kroger. Its PE ratio is near a decade low. Turnarounds, when successful, often reward early believers. But if the answer is no, if stores don't improve fast enough, if consumers stay cautious, if Walmart keeps pulling ahead, then Target becomes a value trap dressed like a bargain. This is a knife edge moment for the company. High risk, high pressure, high uncertainty, and equally high potential. No hype, no smoothing. This is the real picture. If you want more clear, direct analysis like this, the kind that cuts through noise and gets to the truth, hit like, subscribe, and turn on notifications. More breakdowns are coming.